Good day, subscribers. Thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're talking about 5 stocks that pay sick dividends. And not just great dividends currently, but have the potential to pay some even bigger dividends in the future, guys. So I'm going to take you through a couple steps on how I basically sift through companies and basically find these 5 companies I found today, guys. So if you enjoy this video, hit that thumbs up button, and let's just go ahead and get right into this, guys. So number 1 company I found here that we're talking about is Procter Gamble. So Procter Gamble, if you guys don't know, they're one of the biggest, I guess you could say, consumer discretionary companies in the entire world. Walk through your local Walmart or Target or whatnot in the paper towel aisle or toilet paper or napkins or whatever. Walk through those aisles and look at the back of the products. I guarantee you some of the biggest brands are all going to say manufactured by Procter Gamble. They own some of the biggest brands in the world. So that's what Procter Gamble does. Currently, they pay a dividend just over 3%. So that's great. So that's one thing I want to look at. I want to look at the current dividend they pay. So that's good. That's over a 3% yield. It's not bad on $100,000. Invest in that company. That means you're getting over $3,000 per year, basically, in dividends sent to you. We look at their EPS. I look at EPS because that basically shows if they can pay out what they're paying out or pay out more. So they had EPS of $3.75, which is 2 lines up there, versus they had a dividend they paid of only $2.68 per share. So basically they have $1.08 extra in money left over per share so that they could actually increase that dividend in the future. And that's just if their business stays stagnant. Now, if they grow earnings and those kinds of things, then that dividend yield can go even higher and higher and higher. Next up, I'd like to look and just see if they have plenty of cash laying around, short-term investments, long-term investments. That way, in case they stumble upon some financial troubles, maybe they won't have to cut that dividend, or at least cut it very much at all. So Procter & Gamble here, they have over $7 billion in cash and cash equivalents. They have over $6 billion in short-term investments. They have no long-term investments. So basically, they have plenty of money laying around that even if they did come upon some financial struggles, they wouldn't have to cut that dividend, or if they did cut it, it would be very minute, in my opinion, because of the strong balance sheet and because they have an EPS way over what they're paying out in their dividend yield. So let's go on to stock number 2. This one's called North American Tanker Company. Basically, they are like a tanker company. So if you have oil wells or whatnot and you drill those, you need somewhere to put that oil, and sometimes tankers are a good place to put it. So sometimes companies put the oil in the tankers and they just sit out in the sea until they're ready to sell it or whatnot, or if they need to ship it across the country or across the world, I should say, things like that. So Nordic American Tanker, they pay a 12% dividend yield. It's freaking sick. Now, this company is a little different. This is one of those you just want to close your eyes and maybe throw some money at, because that's what, to me, that's what Nordic American Tanker makes sense. Because I'm like, I try to figure things out with this company and look at EPS of 73 cents, but yet they paid out $1.04 in dividend yield, or in dividends per share. So they paid out more in dividends per share than they had in earnings per share last year. Companies like this, I just can't figure out how they do it. I remember I even looked into this company when I was starting to invest in 2008, 2009, because for some reason these high dividend yield companies, they attract new investors. And I even emailed the CEO, and he emailed me back, talking about the company and trying to explain it to me and things like that. I still couldn't quite understand how they're able to pay these type of dividends out when sometimes their earnings per share don't even match those dividends. So it really doesn't make sense, but they do it. And the company's been around at least since I've been investing, and they've been paying fat, juicy dividends for all that amount of time. So, how they do it, I don't know. Now, this company, they have $29 million in cash and cash equivalents. Like I said, that company's a risky one. That's a speculative dividend company, in my opinion. If you want to try to get some great gains, obviously you got 12% dividend yield, that's freaking insane. But you want to do more risky style, that might be the stock for you. I would never mess with that one, just because if I don't fully understand the company and how they're able to pay that dividend yield, I can't invest in it. But that's me. Because I do it that way doesn't mean everybody has to do it that way, guys. So next one up here is we have AT&T, one of the biggest telecom companies in the entire world. You guys may even have AT&T as your sole provider service. AT&T pays just under a 5% yield. So on, remember, $100,000 invested, you're getting basically almost $5,000 per year paid out to you in dividends, basically free money given to you. They had EPS last year of $2.35. They paid out $1.96 per share in dividends. So they're getting pretty close to maxing out that dividend, unless they can find a way to get more and more profitable as time goes on. If they can get more and more profitable as time goes on, they can definitely expand that dividend. But right now, there's basically only about about 40-cent gap or so, 39-cent gap between basically what they're earning per share versus what they're paying out per share in dividends. So there's not a lot of wiggle room to really raise that dividend unless they get a lot more profitable. Now, do they have plenty of money laying around? They have over $5 billion in cash and cash equivalents. They have no short-term investments. They have about $1.6 billion in long-term investments. So they have plenty of money laying around. AT&T. Stock number 4 we are getting into here. This is Las Vegas Sands. This is actually a competitor to one of the companies I'm biggest invested in, which is Wynn Resorts, which I talk about in the 3 stocks to buy videos I do every month. So Las Vegas Sands, they pay over a 5% dividend yield. Now this one looks really bad because EPS of only $2.05 last year, they paid out $2.88 in dividends. But what you got to understand with Las Vegas Sands, and because I know a little bit about their business and whatnot, one is Macau's come back stronger, so their earnings overall should be stronger because Macau's very important for Las Vegas Sands. They get the majority of their revenue from Macau. So that should improve earnings. Also, they opened a brand new resort this year in Macau. That should help earnings. So I could see them definitely earning enough money to pay that dividend. But at the same time, this is a company that's kind of maxed out, even with these things kind of bouncing back, even with the new resort. They're kind of maxed out on what they can pay in dividends at the moment. So, but still, it's over 5% yield. Like I said, 100K invested, you're going to get over $5,000 in dividends as long as they keep paying out those dividends. Their balance sheet, over $2 billion in cash and cash equivalents. No short-term investments, no long-term investments, but that's a lot of money for a company like Las Vegas Sands. They're a gambling company, basically, and a resort company. The last one up here, we have the almighty Apple coming in at number 5. Apple. So right now, it might seem kind of minuscule. They only pay a 2% yield currently. So if you have 100K invested, you're only going to get $2,000 per year in dividends at the current rate they're paying out. But what I love about Apple is they have EPS of $8.31 versus a dividend yield of $2.28. So they could basically quadruple that dividend, almost quadruple that dividend, if as long as they were able to keep earnings the same and just remain exactly as profitable, they could almost quadruple that dividend, guys, and be able to pay it out. So they could pay out realistically closer to an 8% yield if they really wanted to at the moment. Never mind if they can just get a little slight growth here and slowly grow earnings even more over time. This dividend could go much, much higher here, guys. And then look at their balance sheet. This is another reason why they can pay out, insane amounts in the future. Over $20 billion in cash. Over $46 billion in short-term investments. Over $170 billion in long-term investments. So I look at Apple and I see a company that is positioned to pay out ridiculous, insane amounts of dividends over the next 10 to 15 years, as long as they're able to just stay as profitable as they are now, or even begin to get a little more profitable as time goes on. It doesn't have to be great growth in this company. It doesn't have to be any growth, and they can still pay out monster dividends in the future. So Apple I look at and I say, man, this could be a phenomenal dividend company for the next 10 to 15 years, as long as they can keep their business stable or slight growth. Because when you have that much cash, when you have that high of an EPS versus what you pay out in dividends per share, you have a lot of room to move that dividend up over the coming years, guys. I hope you enjoyed this video today. Obviously, if I'm actually investing a stock, I go through, hours of research, more than what we just went through here. But this is kind of like a good way to sift through dividend companies, type in ticker symbols and try to find some good ones that have a great yield, that pay out, hopefully, they pay out, less than what they have in earnings per share. And then kind of looking at the balance sheet, seeing what kind of cash do they have around, what kind of investments, those kinds of things. And that can kind of set you on your way to saying, okay, now I can look into this company more because they meet my criteria, which if you're a dividend investor, which I know a lot of people on my channel are specifically dividend investors, then you can kind of go on to the next steps and kind of research more and more, guys. I hope you enjoyed this video today. If you have not subscribed yet, you may want to. We talk personal finance on the channel, entrepreneurship on the channel. I'm a business owner, give a lot of my business tips away. We also talk the stock market almost every single day, like at least 5 times a week. My voice, by the way, is getting a little better. It's like, I would say like 75, 80%. I hope you guys noticed a little improvement versus yesterday's video, which was the Rich Dad Poor Dad video, which did phenomenal. Thank you for watching, guys, and have a great day.